Hello guys, before we begin this video, I request you to go back to chapter 1 if you haven't watched it. Chapter 1 of the economic survey kind of sets the context for the rest of the videos. This is not a clickbait title because by far this is the most important chapter from prelims perspective because it talks about fiscal developments and basics that are discussed in this video are extremely important for your prelims examination. So what is the state of finances in our economy in the past 1 year? This is what this chapter deals with. In the previous video, we have discussed about agile approach and the waterfall strategy. Agile approach means we will be taking some tiny steps and then take a feedback on those tiny steps before proceeding further. A waterfall strategy is something that other countries have done at the start of this pandemic. They assumed a lot of things without taking hard data into consideration, and because of that they are facing a lot of issues right now. That is called the waterfall strategy. We have discussed this elaborately in the previous video. If you haven't watched it, I request you to stop it right now and go back to that video and watch it. So what is the physical status of India? India adopted a very calibrated fiscal policy approach to the pandemic. Now if you remember, a lot of economists and critics of the government criticized the government that they did not do to give economic stimulus package to the poor in the country. But considering the fact that India was growing at 4.9% of GDP growth just before the pandemic struck, it is very evident that we have very little economic resources. Other countries, unlike India, assumed a lot of things that maybe because of the lockdown, people might not spend a lot of money, so they have directly pumped a lot of money into the economy, even for those who had money with them, or even the economically well off universally got a lot of money, and this is what we mean by front loaded stimulus. How much money was pumped into the economy by different countries? Let us have a look at certain graphs. India, if you see, it was barely 3.5%. But there are certain countries like Japan, 3.5% of Indian GDP we're talking about. But countries like Japan have given a stimulus of almost 53.69% of GDP. And there were countries like US, 26.46%, United Kingdom gave 18.07%. These numbers are staggeringly huge. Look at countries like Brazil. Even Brazil gave 12%, Germany gave 35% almost. What is the implication of this front loading of stimulus? Obviously, inflation will increase. Why? Let us understand. Normally, when there is an economic shock, the assumption is that demand will be low because of lack of money, and to increase demand, fiscal stimulus packages were given. This is the case in the 2008 crisis. But look at the situation here. Because of lockdown, even supply is absent completely because of the factories that were out of production. Consider that with the situation where a lot of stimulus was injected into the economy, now you have too many people chasing too few goods. Obviously, there will be inflation. This is exactly what happened. A lot of countries are now reeling under the after impacts of this policy that they have taken. Front loaded stimulus. Take a look at the situation of Brazil, Russia, US. All these countries are having a lot of inflation in their economy, almost to the tune of 10. In India, the situation is comparatively better. It is hovering somewhere between the accepted range of 4 to 6%. But in a lot of other countries, it is not the scenario, especially middle income countries like Brazil. If you take a look at the indices charts of our economy, you see that WPI is 12.5%, or it is much higher than what was desirable. And if you take the case of CPI, it is just 5.2%. If you take the mandate of the Monetary Policy Committee, they have a accepted range of 2 to 6%. What is Monetary Policy Committee? It is the body that sets or targets the inflation, and RBI will base its decisions based on the decision taken by the Monetary Policy Committee. You might be noticing that WPI is much higher than CPI, and you must be wondering, then how come we can say that the prices are under control? If you take a look at the basket of goods of WPI, we have commodities like crude oil. Now, what is the difference between WPI and CPI? These are basic classes. I want you to post in the comment section regarding that. So, if you take the case of WPI increase, it is because we imported these goods from elsewhere. The costs of these products like crude oil increased globally, and therefore WPI rose. So, this is an imported inflation, not because India, like other countries, injected money into the economy. So, this is the point that you have to note. Now, what is headline inflation? What is core inflation? What is WPI and CPI? I want you guys to please post the answer in the comment section below. When we are talking about the topic of budget, it is basically a statement which says how much the government spends and how much the government earns. If you're talking about the concept of fiscal deficit, the word deficit itself means that there is a gap between how much the government spends and how much the government earns. Basically, fiscal deficit is a measure of how much the government is borrowing from the market or from other sources. Here, you have to understand an important concept called off-budget borrowings. So, what is this concept of off-budget borrowings that the economic survey is talking about, and why is it a contentious issue? Let us understand. The government outsources some of its public services to certain implementing agencies. Let's say if you're talking about food subsidy, government outsources that activity to FCI. Now, FCI might not be sustainable in certain situations because the cost in the market gets fluctuated, but the government cannot stop this food subsidy. So, in such kind of situations, the government might ask FCI to improve its efficiency and raise the required funds from the market, because the very existence of FCI is to ensure PDS. If it is not doing its job in an economically efficient manner, it is the job of the government to hold this organization accountable. So the government can ask this implementing agency, in this case the Food Corporation of India, to go figure out where they will get the funds from. So let's say, imagine in the budget, food subsidy bill for a particular year is X. So the government can say that I'll only pay 50% of this X, and you have to figure out the rest of the 50%. But since FCI is an unsustainable organization because of its huge cost overruns and inefficient economic management, in the public market, nobody will give funds for this organization. So, in a way, FCI will be again forced to take money from certain other government entities. There is something called National Small Savings Schemes Fund, which is directly going into public account of India. This is not government's money, this is our own money, people's money, but it is deposited with the government. Let's say, for example, PF. On this money, the government gives certain interest to the people. Why? Because it is using that money to generate more economic activity. That money is given to FCI. So the rest of the 50% is actually borrowed by FCI, but again it is a liability of the government itself. Therefore, this is called off budget, because this is not present in the budget document, but ultimately it is the government directly which is liable to return this money to the public. So this is off budget borrowing. Back to the topic. Why are we actually discussing this off budget borrowing topic? When government wants to borrow more for its economic activities, there are certain rating agencies which decide whether investors can invest in a particular economy. Let's say if your earning is 100 rupees, you can probably borrow 10 rupees. You cannot borrow 90 rupees because you will not have the capability to pay it back. Who decides that? Rating agencies decide that. Last year, in economic survey, there was a topic called debt sustainability. So our economic survey and Indian economy talked about how these rating agencies are becoming more biased. Let me again explain that at a later point of time. But for now, this is what you have to understand, that a topic of debt sustainability was questioned here. So these rating agencies are now looking at off-budget borrowings as well, because again, that is also a liability of the government. So in order to address the concerns of these rating agencies, government has brought a lot of off-budget items, several off-budget items within the budget allocation, such as food subsidy requirements of FCI. So this gives rating agencies a better picture and increases the credit worthiness of our government bonds. That is, we can borrow more money in the international markets. Investors will have more confidence when they are investing in our economy. This is the basic funda here. Moving on. In the previous video, we have already discussed how the government is going for increased capital expenditure. They are focusing on uh, increasing capex because it has multiplier effect in the long term. We've already discussed this topic. This paragraph is just addressing the same thing again. So here we are going to talk about PLI schemes. So all the initiatives that the government has taken, we will be discussing that at the end of this series in a separate video, because those schemes involve very trivial data which might not be as important in the larger scheme of things. So you just have to understand the concept of multiplier effect and the funda behind increased capex, which we have discussed in the previous video. Moving on. Our economic survey talks about the COVID stimulus package. I'll try to explain the fundamental difference, or the difference in the approaches taken by the Western economies and Indian economy. In the Western model, we have seen the waterfall approach where money was directly given to the people for increasing the consumer expenditure. But we have realized the downfall of that model as time passed on, because supply side shocks. That is, the demand was increasing, but there was no supply. This demand supply mismatch has caused inflation. What was the approach taken by Indian economy or the government of India? We have seen that it is agile approach. Different phases, different steps were taken. So in this COVID package, the overall funda is very simple. If you give money directly to the banks, banks might be having a lot of trouble in recovering the loans. So instead of directly giving money to the uh, people, government decided that it will ensure that banks will have more liquidity, so that there is more amount of loans that are dispersed for people at a very low interest rates, and this generates economic activity in the longer run. But in the short term, the government also ensured that certain welfare measures are taken. What are these welfare schemes? Like we have discussed at the end of this entire economic survey series, we will be discussing those schemes specifically. So all those schemes which are mentioned here, the fundamentals logic behind all these schemes will be discussed in a separate video. So this screenshot shows how the government has taken different steps in different situations. Basically, the strategic calibrated response that we're talking about is discussed here. So in March 2020, most of the money was spent on food and livelihood because that was the immediate requirement. After that, certain liquidity measures were taken for different sectors, as you can see here. And as a result, we have had a bumper harvest and there was no scarcity of food because of these measures. And in the next phase, in October 2020, we focused on boosting the investments in our economy and consumption at the same time. So in a macro level, it is not really important to know what the government did in various phases. It is not important to remember the statistics here as well. You just have to remember the strategic calibrated response approach that the government has taken at different phases of time. Now we are coming back to the basic questions. In UPSC 2021 GS3 mains paper, there was a question. Distinguish between capital budget and revenue budget. Explain the components of both these budgets. So this screenshot is basically an answer for this question. But let me rephrase this entire table so that it is easily understood in a format that is conducive for remembering. a small note to the seniors, those who already know the basics of budget and how certain items are categorized under capital account and why certain items are categorized under the revenue account. You can skip the next 10 minutes of the explanation and directly go to the economic survey trends after that slide. If you have finished your Indian polity revision, you would know that Article 112 of the Indian Constitution says that the responsibility of the government is to present a annual financial statement of the money it gets. That is to say, how much the money is the government spending and how much is it receiving. It should show some account to the population of this country. This budget is one such exercise. Now, the same table was actually discussed in the previous economic survey table, but it was a bit difficult for aspirants to understand. So let us recategorize the same thing. You can take a look at the receipts and expenditure under two heads, revenue and capital. What is the rationale? If something is having a futuristic vision, let's say if you are building an asset, then that is categorized under the capital account or the capital side. Or if it is creating a long term liability, that is if the government has to give back that money in the future, that is considered to be a liability for the future. So all such future assets and liabilities will be categorized under the capital side, and if something is being talked about for the present financial year, then that will be categorized under the revenue part. So what is the source of government in the present financial year? Taxes, non-taxes. Again, taxes are further divided into direct taxes and indirect taxes. You know them already. And what are the non-tax sources for the government? A lot of aspirants get confused here. If the government is selling certain goods or certain services, let's say UPSC is charging for its application fee, that is one source of revenue. The next one, dividends or profits. We have a lot of PSUs in our country. Let's say, for example, IOCL, the oil corporation. So they make a lot of profit by selling the petroleum products. That is also a source of revenue for the government. Thirdly, we have interest that is generated after giving loans to the state governments. This is the source of revenue for the central government. And finally, what is the grant aspect we are talking about? Let's say if some foreign country is giving some grant, not a loan, please remember this, there is no future liability. If it is a loan, it would have gone to the capital side of the budgeting accounting. This is not a part of the capital account. For that reason, please remember, a lot of students make mistakes for MCQs on this specific point. Let's say, for example, US gives us a grant for a specific activity. It is not a future liability. We don't have to give it back. In this context, I would also like to highlight that you have to remember this dividend and profit component of the non-tax revenue. This is a significant issue in the context of the tussle between RBI and the government that happened a couple of years ago. We'll be discussing that. Please remember this point. Now, what about the expenditure here? Why are we really concerned about the fiscal deficit? Look at this first point, interest payment. This usually is the largest component. Year after year, every year we have to pay a certain amount of interest to the public. Let's say government issues government securities by saying that you give us 100 rupees and we'll give you 8% every year. This 8% is non-negotiable. You have to continuously keep on giving. If the government continuously takes more and more number of loans, the ability to pay back will be tested. So where you invest this 100 rupees is very important, and that's why interest component of the expenditure becomes non-negotiable for almost every government, and that is why we have certain laws like Fiscal Responsibility and Budgetary Management Act, etc. Now, the second component, why is grants here considered an expenditure? Let's say if the 15th Finance Commission has said that states deserve certain grants based on certain parameters. We will be discussing that. That will also be a part of the expenditure profile for the central government. Subsidies. Year after year, the government gives food subsidy, fuel subsidy, fertilizer subsidy. All this will again form a significant component. Please remember this. We'll be discussing the trends at a later point of time. And the expenditure incurred for running the administration of our defense. This is also a part of the revenue component or revenue expenditure component. And finally, salaries and pension. The government cannot go back on the promise of salaries and pension. So that is also an year on year revenue expenditure for the government. That is why it is categorized under these heads. So this is the basics that you have to remember. Now let us move on to the capital side. Now when we are seeing the capital side of this budget, we discuss that they create future assets or liabilities. So for the same thing, you will also categorize them as receipts and expenditure. Receipts are majorly of two categories, that is debt and non-debt. Debt means we are borrowing money. We have discussed, right? In the concept of fiscal deficit, the government will always have certain amount of deficit when it is trying to grow. When we reinvest that money we get into infrastructure, that money multiplies. So almost all the governments across the world will always have this deficit if they want to grow beyond a point of time. So it is acceptable. But where we invest, the quality of fiscal deficit is a matter of debate. And that is why issues like debt sustainability are discussed in last year economic survey. In this context, if you are borrowing money, where will this borrowed money be categorized in this budget is what you have to know. This is tested in your preliminary level examination. So the money can be categorized as debt. What are the sources of this debt? Are you raising, is the government raising money from internal sources, that is within the country? Like say for example, it is taking loans from banks, financial institutions, or money markets. Then such kind of a debt or that kind of a loan is called an internal debt or an internal loan. But if the government is taking a loan from a US government or international markets, then that kind of a debt is called external debt. So this is the first concept that you have to know. Then what about this non-debt component and why is it categorized as a receipt? Let's say, for example, the government of India gave a loan to Andhra Pradesh. Uh, so this loan is for a period of 20 years. The money invested here can be some X. And for this X, Andhra Pradesh government year on year pays some interest I. This interest I component will be categorized under the revenue receipts of the central government here, not here. So when the government pays this, that is the state of Andhra Pradesh pays this money X back to the government of India, it is categorized here. So this kind of questions are asked in prelims. So a lot of aspirants get confused between these two. So if it is something that is creating a long-term liability, then it is categorized under the capital side of the budget. Please remember this point. Now the second one, why are we talking about disinvestment? Let's say a company like Air India, recent happening, if government wants to disinvest or move out of that business because it is not making profit, like in this case it sold to Tata, that money, it is neither an annual recurring income or recurring expenditure, but it is getting added to the long term consolidated fund. It can be a cumulative amount. So where do you put it? Obviously under the non-debt component, because it is creating a future asset. That money is an asset where we can invest. That is why it is under non-debt component of receipts under the capital. You have to understand this rationale. Now coming to the expenditure part, let's say why is loan given to a state categorized as a capital expenditure? You know, when you say a loan, the expectation is it would come back to us. So right now money is going away from the government of India to the states. Therefore it is considered an expenditure, but it is not a short term thing, but it is a long term thing. That is why a loan given to a state is a capital expenditure but not a revenue expenditure. Please remember this point, understand this logic. Similarly, if you are investing for acquiring certain capital goods, let's say you want, the government wants to build a machine, it is a capital. With this machine we might be producing something else which adds economic value. That is why it is considered a capital expenditure. Again, if money is going out of the consolidated fund of India, and that is an expenditure, but why is investment? Let's say if the government of India wants to invest in certain company for profits, why is it categorized under capital? Because it is creating a future asset. That is why it is placed under the capital account. But since money is flowing out, it is categorized under expenditure. I hope this is very clear. So these are the basics that you have to understand. So these are the basic concepts that you have to know to understand the discussion further in the economic survey. I hope this is clear. In the prelims examination, this trends of fiscal deficit is an often repeated theme. Now, to appreciate why these questions are asked, you have to understand the context. Like already discussed, what exactly is fiscal deficit? It means that if the government is taking a loan to increase its expenses, fiscal deficit obviously increases. If fiscal deficit increases because of the loans taken, the interest that government should pay every year increases. And this is year on year, every year. It should pay from the budget. So this should not become unsustainable for the government. There is another metric called primary deficit. So here, if we remove the interest component, we'll get some deficit number. So this shows the primary deficit. Why is it calculated? Let's say if we borrow 100 rupees from an external source, or the government borrows 100 rupees from an external source. If the interest payment is itself so high that 50% of that borrowed money is gone for interest payments, and 25% is for subsidies and 25% for welfare schemes, then where will government generate to build assets? How will it pay the interest next year? Again, it will have to borrow. So there is a need for a limit. That limit is actually set by a law called FRBM law. So this is based on a committee recommendation called NK Singh committee recommendation, and this committee said that we should try to limit the fiscal deficit to just around 3% of our GDP to ensure that it is sustainable. If we are going beyond this, we should spend that in asset creation and not in interest payment, subsidy and schemes. Or in simple words, we should not borrow to increase our revenue expenditure because it is simply not sustainable. That is the point we are trying to understand here. Now, let us try to look at the trends. In the past 3 years, before the pandemic, fiscal deficit was increasing because our economy was slowing down. Government was doing everything in its control to increase the spending of people. So, like we have discussed in the first video, consumer expenditure is the main driver of growth in our Indian economy. In the pandemic year, because we went for a calibrated approach wherein the first phase, the government decided to extend free rations to the migrants and the poor people through PDS schemes, fiscal deficit increased. As and when that lockdown phase was eased just before the second wave, we phased out those expenditures, keeping it to bare minimum. So the fiscal deficit came down. As a percentage of the budget estimate, you can understand last year it was as high as 135.1%. Now it is down to just 46.2%. The numbers are not really important. Just understand the concepts and trends of fiscal deficit and primary deficit and the significance of the metric primary deficit. Before the pandemic stuck in 2019, or even to be very precise, when the budget came out in 2019 February, if we take a look at the numbers given by the government, the largest source of tax revenue was corporate income tax, followed by GST and then IT. There are other trends as well, but it is difficult for you to remember. Just understand that after 2020, or as a matter of fact, after August 2019, a significant event happened that was expected to bring in a phenomenal change in our economy. What is the change? Why did the order change? Why did GST become the highest source of tax revenue for the government? Let us understand. So the government has actually decided to cut down the corporate tax, to attract more investments into economy. Let us go back to that formula: C plus I plus G plus X minus M, the GDP formula. So this measure is actually expected to increase the investment in our economy. Now one might wonder, if the news item says that corporate tax rate is actually slashed and it is going to result in 1.45 lakh crore revenue loss, how is it actually going to help our GDP? This is the question we might have. But the thing is, when new companies are investing in our economy, they create jobs, they create value. That is why GVA is a better metric, because it gives the kind of value generated in an economy in a year. What is the difference between GVA and GDP? Please post your answers in the comment section. And the revenue foregone will be compensated by the jobs and the taxes that they will pay through income tax, as well as other taxes that will create a multiplier effect in the economy. So this is the funda here. Ever since after this measure was brought out, GST became the highest source of revenue for the government. It was expected to touch 1 lakh crores every single month, but the pandemic created a havoc, and that is a different scenario. Right now, again, we are back on the track. We are almost seeing 1 lakh crore collections. Now, if you want more details about this, I've made a video on government debt. I'll be posting that video in the comment section below or in the description box below. You can go through that video. It will be much more detailed in that video. Moving on. After that, corporation tax cut. What is the highest source? Like we have discussed, GST is the first highest source, 29%, followed by corporate tax. And then you have taxes on income, that is IT. This is the next source. So you just have to remember the first three. Obviously, the least would be customs. Please understand this. So what is the new order? GST is the highest source, then followed by corporate income tax, and then personal income tax, followed by union excise duties, and last is customs. So this is the order. This is a very important trend for prelims examination. Please remember that. The next important trend that you have to notice here is taxes as a percentage of GDP. And it is not important to remember the individual components, but together you have to understand that tax to GDP ratio is almost 9.9% for the center. That is, out of every 100 rupees that the government earns per year, 10 rupees comes from tax. And what is the fiscal deficit? It is almost 9.9% last year. So government is actually spending everything that it gets as tax revenue, and it is borrowing more as much as it is getting from taxes. So this is the thing that you have to appreciate. What does this mean? Should we actually increase the tax to GDP ratio? Yes, obviously, if this 9.9% reaches to somewhere around 15 to 17%, we can do phenomenally well by spending this money in health sector as well as in education. We always listen that we have to increase our healthcare spending, right? So there are various committees, and even national health policy says that we have to increase our spending to 2.5 percentage of GDP. And there are various committees in education, and even national education policy says that we have to spend as much as 6 percentage of GDP on education. Where will that money come from if not for tax collection? But does that mean we have to increase taxes? Obviously not. So what we have to do is improve tax collection mechanisms. Tax collection mechanisms and evasion of taxes should be avoided. So this is the key takeaway from this chart. This is how you have to interpret everything. Why tax to GDP is important, you will understand from this particular slide. When we're talking about the trends in non-tax revenue, the most important thing that you have to notice is dividends and profits, especially that of RBI. So in the past few years, RBI has been transferring a record surplus of its revenues to the government of India. Now, what is the context? Let us understand. We know that RBI is a regulatory body which is regulated by the RBI Act of 1935. Within that act, there is section 7 which says that RBI should be bound by the orders given by the government of India. Here, RBI being a regulatory body, there should be a level of autonomy for its functioning. Now, what level of money should it retain for it, and what profits should it transfer to the government is actually decided by a committee called the Bimal Jalan Committee, and it said that 5.5 to 6.5% of the assets is what RBI should retain with itself, and the rest should be transferred to the government. After this, in 2018-19, we have seen a record 1.86 lakh crores being transferred to the government of India. So this is the largest surplus in the history of Reserve Bank, and this has actually improved the non-tax revenue of the government. This is the major source. You have to understand this. Now, what is this surplus reserve, etc.? Let's not get into the details because it is not really important. But what is really important is the understanding behind this. So, this issue became a tussle between the government and RBI's governor in the past, and therefore a question was also asked on this issue. Here is the question. However, you don't have to understand the entire controversy behind it. You can solve this through elimination as well. So you can post your answers in the comment section below for this question. Where do you find the provisions for the central government the right to issue directions to the RBI in public interest? The second point, where will you find this particular instruction? Is it in the Constitution of India? I want your answer in the comment section below. This is a question from the latest prelims examination. We are done with revenue receipts. Now, how is the government getting money? From where is it getting money? Another source, we are talking about capital non-debt source. As already discussed, capital side of the budget will have receipts and expenditure, and within these receipts, debt or loan is one component and non-debt is another component or another category of source. Within this, we have disinvestment, which again is a huge issue in the news because the government's motto is it believes that government has no business to be in business. That is, it wants to move out of unproductive public sector entities. So there is an increasing trend of privatization by the present government. How do we know? Let us take a look at these numbers. Specifically, let us have a look at this 2017-2018. In this couple of years, government has almost raised 1.85 lakh crores through disinvestment. And what was the actual target? It actually exceeded the target in both the cases. What does this mean? The government is actually betting big on moving out of unproductive businesses to raise revenue and increase privatization so that a multiplier effect is generated and also government will have revenue. So this is another strategy. This is again a source of controversy. Like say for example, in 2019-20, we were barely able to hit the 50% target. One major reason is buyers were not really ready to buy what the government was willing to sell. Let's say Air India is one example. The government struggled with selling the stakes of Air India for almost 3-4 years after it decided to privatize it. Finally, Tata Sons has acquired it for 18,000 crores. So, a lot of critics said that this present trend of privatization may not be healthy for our economy because the government is actually trying to sell family silver. Now, what do you mean by family silver? Let's take the example of BPCL. This is one more public sector entity that the government wants to move out of. Petroleum, oil and gas is one strategic sector. That is, oil and gas is something that keeps our economy moving because all economic activities are dependent on this. Now, if such a significant player is sold to private entities, we are actually surrendering our interest to the private entities is the argument those who oppose this disinvestment in such sectors. But the government believes that it will generate more taxes because of increased competition, and therefore will have a multiplier effect on the economy. There is a key point to remember here. There is a difference between disinvestment and strategic disinvestment. Disinvestment means government is not letting go of the control of the decisions of a company. Let's say there is a public sector entity X. If it wants to reduce the burden by giving a certain percentage to the private sector, then that decision is called disinvestment because government still holds control. If the government intends to let go of the control also, then such kind of a disinvestment, majorly it means that government is willing to sell up to 50% of the stake. Such kind of a investment decision or disinvestment decision is called strategic disinvestment. Please remember this point. In the economic survey, there is a box which talks about the evolution of the disinvestment policy. What is the takeaway from this box for prelims? A lot of previous year questions asked about the chronological order in which various sectors were nationalized by our government. What is nationalization? Previously, private entities used to run these businesses because of the socialistic pattern of society, that is, government's control over businesses. The corporations were taken up through a certain act. Different sectors were nationalized in different periods of time. This survey talks about various sectors which were nationalized in different years. Now, this order is important because there is a previous year question, like there are 3-4 questions from post-independent era where this order of nationalization was asked in the examination. Since previous year questions repeat, this is important. Air Corporation was the first act, that is nationalization of airways. This is the first one to be nationalized. So after that you have LIC, then the first round of nationalization of banks happened in 1969. Then you have General Insurance Corporation in 1972. Coal was nationalized between 1971 and 75. And finally, second round of banks were nationalized in 1980. So this is the order that you have to remember for your exam. We know the context of LPG reforms. We had something called balance of payment crisis. Now, what is that cannot be explained in this particular chapter. We will be discussing that briefly in external sector chapter. For now, understand that we did not have enough foreign exchange. So, what steps did the government take? The first step is to move out of unproductive public sector entities, unproductive PSUs. So, this is where the disinvestment started. So the term disinvestment was first time used in the interim budget of 1991, as this is what is given in the economic survey. And then you have a department of disinvestment. This was created in 1999 and it became a full ministry in 2001. So after that, there was not much happening except in 2009 and 10, but after that there is nothing significant only until 2017-18, where we have hit almost more than 100% of the target, raising huge revenue. The privatization trend started after that. So this is the thing that you have to remember for your prelims examination. There can be questions here and there. So after the pandemic stuck, we realized that global value chains are very important, and we went for Atmanirbhar policy. What does this Atmanirbharta means? It means that we have to enhance our domestic capabilities, but not at the cost of trade barriers like it was the case before 1991. So we are not trying to go back to that era. We are just focusing on increasing self-reliance. So there is a encouragement by the government by moving out of PSUs and unproductive sectors and increasing privatization, except in certain sectors. So this can be a question for your prelims. What are the strategic sectors according to the new public sector enterprise policy? This was out in 2021 February. So what are the 4 broad strategic sectors? There can be a question on this. One, atomic energy, for obvious reasons, because we don't want our nuclear facilities in the hands of private people. Maybe if we have a enemy country investing in our country, that is a very critical infrastructure. We cannot surrender such strategic sector to them. Similarly, space defense, it is very obvious. Then transport and telecommunication. We don't want to completely depend on private people for this, because if that happens, imagine a case where railways have to shut down because of a private company's decision. We don't want such kind of a scenario. Similarly, power. We are talking about smart cities. All such big activities can happen only when there is undisrupted power. Petroleum, coal, and other minerals are important for our energy security, without which our economy can't run. So it is important to have government presence and government intervention in such areas. And obviously, banking, insurance, and financial services, we have seen why, when it comes to banks, still SBI, which is the largest public sector company or the public sector bank, uh, is considered to be the most trustworthy bank by a significant chunk of this population, because of its government holding. That is the reason, because it is attracting trust. So these points are very obvious. There can be a question on this new public sector enterprise policy. So actually, NITI Aayog is directing the government to disinvest in sectors which it thinks is not conducive for economic activity by the government. So this is the point you have to remember for your prelims and mains. There can be a question on analysis of new public sector enterprise policy for Atmanirbhar Bharat. Please remember that. Coming back, where else can government generate money from? We have been talking about the sources of money. We have discussed about taxes like GST, corporate tax, etc. We have discussed about the non-tax sources like RBI. Now we have already talked about the capital side of the source of money, that is non-debt disinvestment. And another source is, if disinvestment is not working, like we have discussed, we were barely able to hit 47% of the revenue targeted. We went for asset monetization. Now this is different from disinvestment. Please pay some attention. Let's say there are certain projects where government is not actually making money. These are owned by government of India, but they are operated by someone else. Let's say the government is the owner of a road, but toll collection on that road is a big issue. Now, if the government goes forward with a tender for toll collection, a private entity will operate this. After winning the bid, it will take its cut, and after that contract period, pay some fee and hand over the uh, road to the government back again. So this is how asset monetization will usually function. Again, this is created by, the plan is actually developed by NITI Aayog. So this is the difference between disinvestment and asset monetization. I've already made a video on national infrastructure pipeline, and we have discussed elaborately about that. I'll be posting the link for that as well in the comment section below. So please go through that. This is a newspaper clipping from the day after economic survey was out. Economic survey spoke about National Land Monetization Corporation, a special purpose vehicle, that is a separate entity which is created to handle this asset monetization program. So what this government will do is, it will pool the land, and it is handed over to this such special purpose vehicle, which will efficiently manage how to generate revenue from this. Revenue generation will be taken care. This is the only update you have regarding this news. Moving on, we have discussed the sources of government revenue, both from the capital side and the revenue side of the budget. Now we have to talk about expenditure. What expenditure are we talking about? What are the different components? Let us understand. Like we have already discussed, among the items of revenue expenditure, you will see that interest payments in absolute numbers is always the highest, because this is non-negotiable. So interest payments is the highest. It is followed by major subsidies. What subsidies? This subsidies generally include food, fertilizer, and fuel subsidies. So generally, after subsidies, the rest of the components of the revenue expenditure keep on fluctuating. So you just have to remember that interest payments is followed by subsidies. Together, these two constitute the biggest component of our expenditure. It is important to remember this much. If you take a look at this year's budget, again, interest payments is highest. Out of every 1 rupee that we get, we pay almost 20 paisa in the form of interest payments, that is 20%. 8% is for subsidies and defense. This keep on fluctuating year after year. So you just have to remember that interest payment and subsidies form the biggest component, followed by defense. Now, if you take a look at the share of revenue and capital expenditure, you would see that there is an upward trend. There is an upward trend in capital expenditure. We have already discussed the reason for this. The government wants to take an agile approach and increased capex by multifold times, and we are expecting to see certain multiplier effects in our economy in various sectors. And this graph also reiterates the same point. Our non-interest revenue expenditure is very minimal, and capital expenditure has significantly increased. This is the only thing that you have to remember. The next chart that is important for you is to understand the quantum of subsidies that we give in our economy. So take a look at this. Highest component is food subsidy, fertilizer subsidy, petroleum subsidy. Now, here is one activity to you. What is the GDP of our country, and what is the component of subsidy as a percentage of GDP? You just make a rough calculation and post your answers in the comment section below. So we have already discussed how food subsidy bill is one of the highest in our budget. Recently, NITI AYOG, through a discussion paper, recommended that we should reduce the rural and urban coverage under the National Food Security Act. So in this context, let us understand briefly what National Food Security Act is, because this is going to be important for your prelims exam. The National Food Security Act was actually brought out in 2013. As a part of this, 75% of the rural population and 50% of the urban population, that is together 67% of the entire country, would be getting certain subsidized grain as a matter of right. Before this became an act, in the year 2000, the government has launched Antyodaya Anna Yojana. So this targets nearly 5% of the population, where they mostly constituted the below poverty line families, and address their nutritional security issues. After NFSA was enacted in 2013, this scheme was clubbed with NFSA. So apart from these beneficiaries, state governments were given the responsibility to identify certain priority households. This is the important point you have to know. State government is given the responsibility to identify these priority households, and they get certain subsidized food grains like 5 kgs of food grains per person. And at what cost? 3 rupees for rice, 2 rupees for wheat, and 1 rupee for coarse grains. So the existing AAY, that is the Antyodaya Anna Yojana households, they will continue to receive this 35 kgs of food grains per household. Apart from these, there are two important provisions: meal and maternity benefit of not less than 6,000 rupees to pregnant women and lactating mothers during pregnancy and 6 months after childbirth. What is the issue now? Recently, a high level committee headed by Shanta Kumar has actually recommended that we reduce the 67% of the entire population to just 40%. What is the caveat here? When we are saying 67%, this is based on census 2011. This is very old data. Now, if we keep the percentage at 67% itself, this would mean we would have to add more families into this list, and as a result, the government would have to spend nearly 47,000 crores every year as an additional burden on an average. Therefore, Shantakumar committee has recommended that we bring down this to only the deserving people, that is 40%, and we would be utilizing this money in either health or education. Now look at the big picture. When we were discussing about our tax to GDP ratio, which is roughly around 10%, we have already discussed that various committees recommended that we have to spend at least 2.5% of our GDP on health and 6% on our education. If we don't reduce our subsidies or increase our taxes, how else are we going to fund it? This is the question. Also, there is a lot of issue of leakages in this particular scenario. A lot of grains get wasted because of the mismanagement of FCI. So government is experimenting with initiatives like e-rupee. I've made a video on e-rupee separately. I request you to watch that. I will be posting the link of e-rupee video also in the description box below. So this is about food subsidy, NFSA, and the need for revision that NITI Aayog discussed. So this is important for your prelims examination. Know the details about this. If we go back to our constitution, Article 1 says that India is union of states, but at the same time we have subnational entities called state governments. So in that context, how do we balance the center-state relations is one of the biggest challenge for Indian federalism. Center-state relations, especially in the domain of financial relations. It is here Article 280 or the Finance Commission, which is a body that decides or comes up with a formula for sharing the central divisible pool of taxes. Central divisible pool of taxes. So central government has certain tax pool and Finance Commission comes up with a formula to decide how much money out of X that the central government collects, how much of that should be transferred to the states. Finance Commission decides this formula. However, you have to know that when you're talking about this central divisible pool, there are certain taxes which are not included as a part of the formula. UPSC usually focuses on these exceptions. So please note these exceptions. Now, what are the parameters considered by the 14th and 15th Finance Commissions for devolution of taxes? So these are the parameters. You can just download the document from the Telegram channel and take a look at this. There's nothing much to explain here. These are already discussed in the basic classes. Now, Article 275 gives the Finance Commission or empowers the Parliament to give the power to the Finance Commission to give grants to the states. So the speciality of the 15th Finance Commission is uh, seen in two specific areas, that is sector specific grants and state specific grants. So these two components are for the first time given in the 15th Finance Commission. Let us see the trends. As you can see here, sector specific grants were absent previously in the 14th Finance Commission, and so did the state specific grants. So these were introduced for the very first time. And there is something very peculiar about the disaster risk management grants as well. There is a significant increase for these grants, but there is also a caveat. What is the caveat? Let us understand. So this is actually posted on the Telegram channel. You can just go through these documents there. The Finance Commission observed that when you want to deal with disaster management, the quality of expenditure is equally important. Naturally, when a disaster strike our states, the response would be to focus on rebuilding the state. So usually, not a lot of work is done for mitigation of disasters. And if we take a look at the Sendai framework, disaster readiness is very important and a central aspect for disaster management. Uh, but the Finance Commission observed that a lot of states are not paying a lot of interest in handling this mitigation issues. So therefore, it mandated that 20% of the fund is spent for mitigation activities, and the rest 80% is spent for response, including 10% for disaster management. This is a novel idea, and in this way, 15th Finance Commission is actually directing the expenses to improve the quality of our disaster management services. The next thing that we have to discuss is the structure of public debt in India. Now, why are we discussing about public debt? When we were beginning this budget topic, we discussed the importance of fiscal deficit and how rating agencies will actually look at India as an investment destination. Higher the debt, difficult it is for an investor to trust us. The funda is very straightforward. So, objective here is to understand the structure of our debt and what is the fiscal space for our country. Fiscal space, that is, how much more can India borrow for increasing its growth. This is the objective of understanding this public debt. Now, when you're talking about public debt, it involves both the center as well as the state governments. When we were discussing the issue of budget, on the capital side, there are receipts. We've already discussed that. We have seen how non-debt components means disinvestment and other avenues. We are talking about the debt component here, and it involves internal debt and external debt. So this is what we're talking about. Internal and external debt under the capital side is what we're discussing here, because it is important for our sovereign credit rating. That is India worthy enough for its investors? Let's understand. One way to categorize this is internal and external debt. Let us understand what this external public debt means. Now, when you're borrowing money from the international markets, this does not include private companies. Please remember, take a look at the name. We are talking about public debt, that is government debt. So this component is usually very low. It's actually very low, roughly ranging between 2 to 3% of our GDP. So we can say that currency risk for India is pretty low, because what do you mean by this currency risk? Let's say if $1 today is at roughly around 75 to 80 rupees. Tomorrow, if something happens and the value slips to 130 rupees per dollar, and if India owes US, let's say $1,000, the value would obviously increase in terms of rupee. That would actually make us even more stressful or even more burdensome. The situation would be very difficult to sustain. So this currency risk is decreased in the present case of India, because we are not exposed to external debt that much. Most of the external debt is in the form of external commercial borrowings of the private companies only. Now let us talk about the internal debt component. This internal public debt is further characterized into marketable debt instruments, non-marketable debt instruments. Marketable means they can be traded on stock exchanges. So let's say if government gives a GSEC for 8% interest, if I am acquiring that particular GSEC, I can go sell that in a stock market and gain profit out of it. Similarly, state government securities can also be marketed. But there are certain non-marketable debt instruments like treasury bills, small saving schemes, and other obligations, which can be categorized as miscellaneous categories. So these small saving schemes include, let's say for example, Provident Fund. This Provident Fund is actually accumulated from people's salary itself for their retirement. Now, obviously, this cannot be allowed to be traded in the stock market, because it is a very risky thing to do. People's lifelong savings is at stake. So, the government would not be allowing trading of these sort of debt instruments. These would definitely go to public fund of India, which is defined under Article 267 of our Constitution. And these other obligations also involve, let's say, for example, an NRI remits that money to his Indian account for a long-term fixed deposit. It is a possibility that since this is a very stable capital, Indian government might want to use this capital and in return offer an interest. So this is a sort of a debt, but the liability would end only when the government pays back this debt. Therefore, it is something that the government cannot afford to risk with. That is why it is a non-marketable debt instrument. So this is the categorization of government securities. Let us also understand an important point: monetization of deficit. So we have discussed how in the times of pandemic, fiscal deficit has increased significantly. Governments did not know what to do. There was absolutely no avenue for borrowing. One option that was considered at that point of time is printing new money to distribute. A lot of governments across the world also considered this. So what exactly are we trying to talk about? This printing of money to fund the deficit is nothing but monetization of deficit. But the problem is, if you are printing money, let's say if there is a supply of 100 rupees in our economy, we decided to print more money and added 100 more. Okay, so there is only availability of one product which was usually priced at 100 rupees. Now the person who has this 100 rupees will be competing for this product, but because of the injection of this additional 100 rupees, another person Y might also want to acquire this product which costed 100 rupees. Since there is demand, now there will be a rise of the price of this product. It will become 200 rupees, let's say. This increase in the price is called inflation. When it becomes uncontrollable, this printing of money will obviously become unsustainable. So if RBI has to uh, take out that money from the economy, it should give something back to the people, because government itself gave that 100 rupees to this person. Why? Now why would this person give that money back to the uh, RBI? So it is in this scenario you have to understand that for every rupee printed or minted, there should be a certain asset which can balance the balance sheet on the other side. So this is monetization of deficit, which is undesirable, and therefore from 1997 this practice of printing money in an ad hoc manner was actually toned down by the government with certain conditions. Actually this practice was stopped in 1997. So a historic agreement between Government of India and RBI gave rise to a scheme called Ways and Means Advances. So this ways and means advances is nothing but a short-term loan that RBI will give to state governments for temporary mismatch, but it cannot go on for infinite period like this, like it was going on before 1997. So after 1997, what usually happen is, if government needs money, it would go to the market. Let's say if I am involved in the market and it wants money, government will print certain GSECs and ask the government to issue, or ask the RBI to issue bonds, and I would buy this bonds, and government would pay me, let's say 8% interest for every 100 rupees borrowed. So when we were discussing about revenue expenditure, we were talking about interest, right? This is the interest that we're talking about. Now if this becomes high, it becomes unsustainable. What the government does with this 100 rupees will determine time and again the future of our economy. So monetization of deficit directly is a bad thing to do, and therefore we move towards this sustainable model where we'll be borrowing from the market. And that too, a limit was set after 2003, where Fiscal Responsibility and Budget Management Act came into the picture. So this act said that we should aspire to reduce our fiscal deficit to 3% of our GDP. Now let's take a look at the interest rate on central government securities or G-Secs. So if this is high, it means that nobody is willing to trust our government, and therefore government is willing to take that additional risk by paying higher interest. But if you take a look here, despite the fact that fiscal deficit is increasing, our interest rates are actually falling down. This is a very good sign because it means that there is high demand for government securities and that trust level on our government's performance is very high. Therefore, interests are falling down. This is an important point to note. Also, if you take a look at the center's debt to GDP ratio, it is continuously increasing. It is almost touching 60%, 60% debt to GDP ratio. This is not what FRBM Act mandated, but considering the extraordinary times that we are in and also the demand for capital expenditure, this is continuously rising. But at the same time, you also have to remember that our interest is falling down. So this is a call by our government to the credit rating agencies to be very wary of the ratings that they're giving to India. India is projected to the world as a land of investment opportunities, and this is what the government is trying to project through these graphs. Another metric that economic survey uses is maturity profile of outstanding dated central government securities or G6. So in short, if I say that short term loans are high, it means that government's debt liability is going to be very high in the near future. Obviously, no one would be willing to give us more loans because we have to clear the existing loans in a very short span of time. Let's say 5 years. Now take a look at the profile of loans. You will notice that long term loans, that is 20 years and above, is actually increasing over the past comparative period, that is 2012 and 13. So this means that long term loans means we will have more time to pay off these loans and create more infrastructure and therefore grow at a very fast pace. So last year the economic survey actually discussed a concept called IGRD, interest rate growth rate differential. I've already discussed this in the government debt video, but I'll be repeating here once again. Let's say uh, if we take a loan of 100 rupees at the interest rate of 8%. Now, if the government invests this 100 rupees in a project that generates 12% annual return, we are actually having a 4% net positive return. This is the interest rate growth rate differential. And last year economic survey has actually given a historic example of Lucknow's Imambara, where that monument was Imambara was actually constructed using this interest rate growth rate differential logic, and it proved to be a economically viable model. So this chapter on debt sustainability last year also reiterated what it is trying to say this very year, that India's economy is growing, and despite our tax to GDP growing at a very rapid pace, our interest rates are falling down, and therefore India is a very good investment avenue. Why are we talking about investments? Let's go back to the basics. Consumer expenditure is more or less stagnant, and if India wants to grow at a rapid pace, we have to attract investments. That investment should go into infrastructure. That infrastructure will create a multiplier effect, and that multiplier effect will grow the GDP. And if we reinvest and redistribute, this will lead to development. This is the basic funda. Reinvest and redistribute how? Through higher taxation collection and more welfare schemes. So this is the basic funda. If we really aspire to spend 2.5% of our GDP on health and 6% of our GDP on education, this is the way to go forward. Finally, if the government is serious about generating more internal debt, there is one untapped area, that is bond markets. Common people do not trust the stock markets, but at the same time, they trust the governments. So, till now, individual buyers are not allowed to invest directly in government securities. To address this anomaly and to deepen the bond market and raise more internal debt, deepen the bond market, uh, what RBI did is it launched a scheme directly for retail investors like common people. So for this, they created a platform called NDS-OM. So this was the question asked in prelims last year. This NDS stands for Negotiated Dealing System. So through this platform, common people can start investing in G6. This way, government has done every possible thing to raise more debt and generate more economic activity in our country. So I hope you understood some very conceptual things about our fiscal policy and completely understood the concept of fiscal deficit and the various trends discussed in economic survey and also the important issues in the past 1 year. So it is completely related to the budget chapter as well, which is a part of your GS3 syllabus. Revise this once more, probably listen to this lecture twice. Most of the themes that are important for your prelims revision are thoroughly covered along with static concepts and current affairs. I think this would do for you. That's it for now. Please share this video, like it, and subscribe to this channel. That's it for now. Thank you.